Good morning, good afternoon, good evening, everybody. I can't believe this is an anomaly. I ran late 2 weeks in a row, really late last week. And today, just holidays and time zones, I'm all mixed up. And I accidentally ran way over in the equities room. So my apologies, but I'm here now. Let's rock and roll. Give me just a moment to adjust the projector. In that time, if there's anything on your mind, comments, questions, or trades, post them. Okay, Walter, Ty, Tao, Sonny, Perry, Matt, Christopher, double Christopher. Usually it's double Betty's. Brian, and Betty and Audrey. It is great to see you. Let us press forward here. Once again, I have zero open topics, which is very unusual. Usually I have some open lesson plans. Usually I have some open questions to further go over with you. Questions basically coming from all of you, not from me. And quite often we have open trades that run from one week to the other. We have zero. We before the Labor Day holiday, we really wrapped up. So if there's anything new on your mind at all, feel free to post it. Comments, questions, actual trades. Other than that, I'm going to get to some chart review. And I do have a little lesson just on the fly, something that I was inspired about from Dr. Dan's semi-private coaching room. Now, Dr. Dan is the lead educator in the equities room, the equities day trading room. It's different than this room in the fact that that focuses on day trading. We focus on swing trading, and that is a program where people are working to graduate and get their trading funded for them. Here, everybody trades their own money. So Dr. Dan, not only being the lead educator on the equity side, the equity trading room, but he also does a couple of extra educational initiatives based on the popular demand from his students. One of them is once a week on Wednesdays, he has a semi-private coaching group that really focuses on his style of day trading, which is based on the IFT methodology. And he mentioned something today, and I thought, "Ooh, that's interesting. I'm going to work with that thought a little bit and create a little bit of a lesson, which I will probably share not only here, but I'll probably share in the equities room too, and the forex room, because I do put in a little time in each of those rooms. Well, in forex, again, little bit of orientation about me. Most of you know this, but I guess my volunteer hats at IFT are the following. Well, first and foremost, I'm a trader. First and foremost, I'm a trader. That's how I make my living, and IFT has been an instrumental part of that as far as my own trading methodology, the access to risk capital, thanks to the IFT organization, and all that sort of great stuff. Then outside of that, my volunteer roles, I am the lead educator in the Forex program. I help out in the equities room. I sort of do middle of the day lessons. I'm also the lead educator in this program and soon to be the lead educator in the revived options program. And I know some of you are interested in the revitalization of that program, which will probably start the first quarter of 2022. Ty, thank you for that heads up, but however it works for you, it works for us, so thank you. So the first thing I'm going to do is get over to the overall market, and I already have the charts up on the screen. I have the SPY. Now remember, we use the SPY because it's an ETF, an exchange traded fund of the S&P 500. We use the S&P 500 as a barometer of the overall market because it truly is the best. It is the top 500 publicly traded organizations in the U.S., in the U.S. equity market. Now, is it the same 500 year to year? Absolutely not. There's always companies dropping, being added and dropping out. So it really is a little capricious when you think about that. It's really interesting when you think about some of the psychology in trading. And let me sort of touch upon this because it's an interesting environment to think of, and maybe this is getting a little bit into fundamentals where we are predominantly technical traders, right? Fundamentals are more about economic events within the world, economic events within individual companies, where we're more technical traders, where we follow the charts. But every once in a while, understanding the landscape and touching upon a couple of fundamental things here and there, which we do almost every session, something will come up which is more of a fundamental question, and I'll address it. But on a little bit more on the fundamental side, two curious things about this stock market amongst an infinite number of curious things. One is, when you think overall with the stock market, even with some incredible crashes, right? The onset of COVID crash, the fiscal crisis of around 2010 crash, the real estate bubbles 2006 crash, the dot-com bubble crash, 9/11, which again, hard to believe, the 20th anniversary. That really, even more than the passing of my own age, the 20th anniversary of that, as far as a marking of time, is very, very substantial for me. It's just, just mind-boggling for me. But 9/11, crash, what was known as the Asian contagion, when there was problems with various Asian country monetary systems. Crash. When I say crash, crash or serious pullback. 1987. On and on. There's no... Oh, excuse me. I did not hit the cough button fast enough. I apologize if I blasted your eardrums. But there's no lack of serious pullbacks and crashes. But when you think about it, what is the main overall trajectory of the stock market? It's upwards. If you take any 10-year snapshot of the stock market, it has appreciated approximately 10 to 11% compounded year over year, even with all those serious pullbacks and crashes. So one thing to always have in the back of your mind is the fact that the whole machinery of the stock market is made to appreciate, to go upwards. Now, again, that may be hard to believe, and the run we've had the last 12 years, it's like, come on, we must be getting closer to the next serious pullback and crash, which we probably are getting closer and closer to that. But the overall spirit, the overall mechanism, the overall the way that the stock market is put together is really bullish, right? If you think about it, first, the human psychology, always, if you really think about it, when you hear things on CNBC or Bloomberg, it's always about appreciation. You very real, once in a while you'll hear a trader on CNBC say, "Oh, I've taken the short side of this," but it's all about building the long portfolio, building the long hedge fund, building the long mutual fund. So in that, even the professionals in the in the mutual fund and hedge fund portion, predominantly, they're all taught to the bullish side. How do I build a portfolio that appreciates? Then on top of that, when you think about it, unless you get into a program like one of IFT's programs, you're not really taught about the short side. I would say about once a month in the equities room, or even here in this program, maybe once or twice a year, a very new person arrives, a new person not only to IFT, but a new person to trading, and they'll say, I'm not really sure about shorting. Again, I'm sorry about the coughing. Give me just a moment. So if you think about it, you know, if you see a new person here once in a while, or a new person in the equities room once in a while, you'll hear them say, I've heard about shorting, but I've never really done it. I'm really not comfortable with it. I really don't know much about it. And the whole concept of buying low and selling high, being bullish, is natural to people. The concept of selling high and buying back lower is foreign. Why? Because the industry promotes and advertises and builds upon the prior and not the latter. So everything is really more stacked on the bullish side. Does that mean it's guaranteed on the bullish side? No. As I went through the time periods, there's extremes of bearishness. But once again, what do they say? The bear markets take the elevator down, but the stairwell up. In other words, it's a long enduring climb going upwards that lasts a long time, but then when the downward happens, it usually happens quick and fast. Nowadays, if you took the last 50 years, the average, especially if you put in, this last bull run, I bet you the average bull market must be 6 to 8 years. The average bear market, 18 months. If you really look at the last 20 years, the bull markets are more like an average of 8 to 10 years, and the bear markets are an average of, I don't know, we're lucky if we get 6 months. Maybe we hit that 18-month, 2-year period during the fiscal collapse of 2010. So am I telling you that in your swing trading, all you should do is bullish stuff? No, unless that's all you're comfortable with. But I do want to every once in a while, get a little bit deeper, maybe wax poetic, and just get into a little bit of this mindset. Also, this is a thought that struck me really not too long ago, even after all these years, not too long ago. The markets really overall, not for us traders, but for 90 some odd percent of the participants who consider themselves more investors, right? And all of us are investors also, whether directly or indirectly, with 401ks or pension plans through employment, or even if you run a business and you set up a 401k or a Roth IRA or something, that whole industry, like every business, is based on consumption. So everything that is built into the industry is all about consuming and buying more. The automotive industry wants you to consume and buy more cars. The pizza industry wants you to consume and buy more pizza. Well, the stock market's no different. It wants you to consume and buy more equities, right? Why is the mantra buy and hold? What the mantra really is, buy, hold, and buy more. Interesting when you think about it. So, little bit of thought, as you look over the years, or if you track your trading, and many of you have been at this for years. If you have a lot library of your trades, and really think about month after month and year after year, usually in the long run, bullishness prevails. Once again, does not mean only go long. Does not mean going long works 100% of the time. It doesn't mean that there are not major pullbacks and crashes, but those are usually short-lived. So what got me onto this? Oh, I was talking about the overall market in the S&P 500. So when I see a daily chart like this, I am amazed at the beauty of the bullishness and the longevity of the bullishness on a technical degree, but on a fundamental degree, it kind of makes sense to me. It kind of makes sense that everything is geared for consuming more, buy and hold, and the whole market is predominantly built around a bullish bias. Another thing about the S&P 500, and here I think once you think about it, it's really not deceiving at all. But when before you step back and think about it, it is kind of deceiving that, oh yeah, everything is about consuming more and buying more, like every industry. And here's another thing with the S&P 500. Think about this. Until you understand it, it's a little deceiving. And it's the following, and I mentioned it earlier. The 500 stocks in the S&P 500 this year is not the same as last year, is not the same as before. What is the S&P 500 really? It's the 500 best performers. Laggards are thrown out. Laggards are thrown out. So even the machinery of what we use as a barometer is stacked to the bullish side. Underperformers are tossed, new leaders are put in. I call that stacking a deck. So I hope you enjoy conversations like this also, just to broaden your thinking a little bit about the markets and things like that. Does it really have anything to do with the next VBS or VSS you take? No. But understanding the environment you work in is important. It's like playing a sport and getting over to the playing field and understanding, oh, in this playing field, let's take baseball. The Boston field has that famous wall. I don't know whether it's left field or right field. Yankee Stadium, the setup is different. Well, if you're a professional ball player, you're going to get to want to know each one of those stadiums and the little nuances about them. Thanks, Matt. So here is the S&P 500. And what a beautiful opportunity. Is Garnett here today? No. Garnett was very kind last week and shared his VBS. He shared his VBS, which was right here. Let me get a yellow marker here. This was the VBS he worked. And I kind of hope he's kind of still in it, right? It had a little pullback and then surged again. And now are we really getting another opportunity for possibly another VBS here? I don't know. But if the 20 holds, I'm going to try it if it triggers. So what would that be? Once again, you evaluate your own trading. But if I'm taking a VBS, right, I always tell you about those 4 checkpoints in my checklist. A VBS, number 1, do I have a rising 20? The answer is yes, check. Number 2, where am I in market law 4? That's I'm going to check that off, but that's a little bit of a concern, right? 1 move up, 2 moves up, 3 moves up, 4 moves up, 5 moves up, 6 moves up, 7 moves up, 8 moves up, 9 moves up, 10 moves up, 11 moves up. This trend is starting to get a bit older. But you know what? I'm going to keep working it till it stops working. If I take a trade and it flops and the 20 gets broken, boom, I'm just done. It's just one trade. If I ignored every other VBS and every other RBI along this, I would have missed a lot of opportunities. So even though this trend is getting a little older, and I know that, number one, do I have, for the VBS, do I have an upward 20? Yes. Number two, where am I in market law 4? Yes, the trend is getting older, as long as I'm aware of that. Number three, do I have a market law 3 pullback? I would say yes. 3 to 5 to 8 bars back to the rising 20. All I'm waiting for is the last point, what I call the event at a location. The event at a location, I'm just waiting for a subsequent bar to take out a prior bar at or near the location of this rising 20. Is it triggering? No. If it triggers, will I take it? Yes. So there's if you think what I just did in a compounded fashion, sort of went through the history of the stock market with you, with my feeling that it's always stacked a little bit more to the bullish side in long run history. Number two, did a review of the S&P 500 via the SPICE chart on the daily. And number three, threw out to you what one of my next trade ideas are for me. You judge based on what you like and dislike and what you trade and you don't trade and what's in your plan and not in your plan, whether that trade idea is appropriate for you or helps you at all. So let me head off to another chart. Let's take a look at the triple Qs. As I always explain, I always like to look at the SPYs and the triple Qs at the same time because, in my opinion, and I've been hearing this more and more in the business media too, the triple Qs represent technology. And technology is becoming more and more of the driving force behind the whole market. I would say, in my opinion, technology has been the main driving force of the general market for at least 20 years. It's just becoming more so. Maybe 20 years ago, technology represented 1/5 of the S&P 500. Today, I don't know this specifically, but I bet you it's over 30%. I bet you it's over 30%, which is a pretty heavy weighting. WEIGHTING. Well, Christopher, think about it this way. Here, let's bring up a monthly chart. Now, I have a question about your question, but let me go back historically first. I'm going to go all the way back to the great financial crisis of 2008 to 2010. Let me ask the room, do you think this chart was good for wealth building? Now, this is a swing program, but I am going to take Christopher's wealth building question. Do you think this has been a good market for wealth building over the last 10 years? There you go, Christopher. There's the answer to your question. Right? It's crazy. It's incredible. Could you imagine if you bought the SPYs at 100? We're at almost 500 now. That's quintuple in a decade. Now, that's the answer to your question, Christopher. What about right now at this moment? Is it good for future wealth building? I would still say yes, but based on IFT methodology, let me ask this room. Is this chart looking a bit more I for igniting or E for possibly exhausting. Right. Market law 4, I'm not even going to count the number of moves. Market law 3, look how stretched out and far we're starting to get from the 20. So, now this is a monthly chart. Every bar represents a month. You know, would I be surprised 8 months from now if there was some sort of pullback like this? No, I wouldn't be surprised at all. That's only natural. An average of 3 to 5 to 8 bars up, even though this has been something like 13 bars up and 3 to 5 to 8 bars back to the rising 20, no, I wouldn't be surprised. Now, the news media would call this a crash. I call this a natural technical pullback on the monthly chart. It's a healthy pullback. So, from this point forward, thinking that this is going to go another 13 or 20 bars straight up is probably defying gravity a little bit. But if you plan your wealth building over time, accumulating a little bit of the SPY, right, the SPY ETF, take advantage of pullbacks, basically, what people call dollar cost averaging. Isn't that what Oliver does? Now, Christopher, I don't know if you're in Oliver's wealth building program or in his crypto program, but that's exactly what he talks about planning your buys over time and accumulating over time. You're going to, like right now, I think now is a great time to buy a little bit more crypto with a 10% serious pullback, and some cryptos a 20% serious pullback in the last 24 hours. But again, I'm not advocating instruments. I'm not advocating, what your plan should be. I'm just here to keep reinforcing and teaching the IFT methodology. So, Christopher, I'm glad that was helpful. Thank you for your question. Thank you for your question. The Qs. I wanted to get over to the Qs. Let me do that. Let me get back to the daily chart, because the Qs are basically the driver of the overall market. Let's take a look at that. Now, this is a chart of the QQQ, which represents the top 100 stocks. The value right now is about $380 a share for the ETF. There is also something, the TQQQ, which is about 1/3 of the dollar amount. But if you notice, take a look at this. Here's the QQQ chart, right? $380. Let me pull in the TQQQ chart. It's the same exact pattern, but the TQQ is about $150. So depending on your account size, you may want to trade something like the TQQ rather than the Q. And there's other ones, the SPY is about $500 a share. There's definitely other ones like the SPXL, right? That's about $123 a share right now, if you want to use other ETFs. So the beauty about these broad-based indices, there's usually at least several ETFs for each industry. And then on the other side, there's the contra ETFs, right? There's the ones that go on the short side of it. Like the QID would be a short ETF on technology. All right. So here on the QQQ, just totally bullish. I thought somebody here, maybe it was Garnett again, somebody here was trying, they felt that this was like a gift formation. Well, I hope they gave it a try. I did not. No particular reason. This is kind of normal for me to do, but with an entry there, I don't know, you choose to stop right under the setup or right under the 20. Definitely hit about the 1R area. So if anybody did take that since last week, I think it was Garnett that brought it up. He showed us his trade on the spies, and then he brought up what he felt was a potential gift formation here. Now, once again, are we going to do another gift formation here? I don't know. Or is it going to pull back further into the 20 and maybe another VBS? I don't know. For all I know, tomorrow's bar may be just one massive crashing bar. No, nobody truly knows, but we play what is, and we're prepared for whatever might happen. How are we best prepared? What is the number one tool in our arsenal to make us best prepared for the unexpected? What is the number one tool in our arsenal to make us prepared for the unexpected? Come on, Walter, Ty, Tal, Sonny, Perry, Matt, James, Christopher, Brian, Betty, and Audrey. Somebody must be able to utter the two-word answer. Christopher, you're right about the stop. James, you're right about the stop, but there's something else with the stop that's just as much, if not more important than the stop, right? Let's see, something that failed here, back here. Let's say I took this VBS back here. I entered here, and I put my stop, that's the green line, and I put my stop right under the setup there. Yes, this stop is very important. The stop and stop loss is very important. But what do we use that works in concert with the stop loss that's even more important? Not a trailing stop. Thank you, James. The risk unit. Come on, everybody. Come on, everybody. We're all veterans here. I'm surprised that I have to kind of drag it out of you.
Oh, no.
Oh, no. I'm surprised I kind of have to drag it out of you. The risk unit, right? Think about this. Let's say you have a $20,000 account. Let's say you have a now this will really hit it home. Let's say you have a $20,000 account. And a $200 risk unit. Or, no, let me say this a different way. I apologize. I'm changing gear. What if, let's say you have a $20,000 account. Okay, your account is $20,000 worth of your hard-earned money and principal in it. $20,000. And you do this trade. And let's say there's two people. There's, I'll pick names that are not here. There's Kevin, K for Kevin, and S for Sally. Kevin and Sally both have $20,000 accounts. Kevin and Sally both take the same exact trade. The VBS, the entry here, the stop under the low. They're both using the same exact stop of $104. The same exact stop. But Kevin, if it hits that stop, Kevin is going to lose $200. But if it hits that stop, Sally is going to lose $15,000. Is that possible that two different people could take the same exact trade with the same entry and the same stop and manage the trade, that one might lose 200 and the other one might lose 15,000? Yes. So the stop loss is important, but not not as important as the risk unit that backs it up. So let's see who remembers. All of you trade your own money. When you trade your own money, your risk unit should be less than or equal to what percentage of your capital? Your maximum risk unit should be what percent of your capital? There you go. That's the maximum. Most successful professionals would say the following. Most successful professionals would say 2% or 2% should be your maximum that you use for a risk unit, but you're probably better off with much less than that. I'm going to throw something out there to you. Again, people in the equities room ask me to share personally all the time. In the Forex room and here, I usually answer questions honestly, unless there's a question that I think is valuable. I usually don't go on about myself, but can anybody guess what my risk unit is? Can anybody guess what my risk unit is? Just take a guess. It actually is so. Once again, um, you know, conservatism, I feel prevails. So I'm not saying that that's what you should do. Just do not exceed the 2%. Just do not exceed the 2%. Sure, James, but it's neither here nor there because the most important risk unit is yours. And then once you have a risk unit, the most important thing is to use it appropriately. Because think about that. Most people do not use first off, most people do not have it. And then when finally they're beaten up so much, they finally turn around and say, well, maybe I should do it the right way and use it. They develop a risk unit and they go through a period, sometimes forever, that they don't use it. Let's see, what can we go on to next? Let's take a look. I'm just being selfish here because I haven't looked at it in a while myself. I'm curious on taking a look at the financial services industry. I use the FAS for that. And this is interesting to me. The overall market, which we use the SPY, bullish. The technology sector via the QQQs, bullish. I would say the financial services industry, which outside of technology is probably the secondary driver of the overall market, is flat. I would call this flat. Look at that flat and wavy 20. So I would really like to see the financial services industry kick in a little bit. It would be nice if it took out these former highs and got bullish like technology and the overall market. Right now, really nothing for me to do with this. And you know what, everybody? I might just wrap up right there. I might just wrap up right there for today. I think, the education and going over the overall market, touching upon technology as a sector, finance as a sector, that's a little bit of chart stuff. You know what? I'm going to do a little bit of top-down look at a couple of things, and then I'll call it a wrap. But I think, the education, talking about the overall market and the tenor of the market usually being stacked to the bullish side, I think that was definitely a valuable lesson, although not strictly on technical trading. So I'll tell you what, I'll take a top-down look at 3 stocks or ETFs, whatever you want, and it'll be the first 3 that you list in this room. Give me 3 stocks or ETFs or currency pairs. Don't forget, we do cover Forex in this program also. So just the first 3 that I see listed. Okay, there's from Christopher Sage. I am not familiar with that at all, but let's take a look at that. Okay, Airbnb. There's the 3: Airbnb and the Great British Pound versus U.S. dollar. SAGE. Oh, first thing I would say here, I'm going to bring up a level 2 screen, which I really do in this room. Why, from an IFT perspective, now, Christopher, I'm not saying this is anything wrong for you, but from an IFT perspective, can anybody tell me why an IFT trader would avoid this stock? The answer is on the level 2 screen, not on the chart. The spread, possibly, it's only 10 cents, Perry. It's only 10 cents. So from a day trading perspective, maybe. From a swing trading perspective, 10 cents probably is not a big deal. Christopher and James had it. Here we are at 2 o'clock in the afternoon, and it hasn't even done 200,000 shares. So liquidity could be an issue with this. Liquidity could be an issue with this. So with that, though, let's get back to the chart. The monthly, boy, these are crazy monthly gyrations. Oh my goodness. Runs from 40 to 200, back down to 80, back to 200, back down to 40. Definitely over the decade has had some wild gyrations. Let's take a look at the weekly. Weekly, massive drop back down to the $40 area. Try to make it back up towards 100, now back in the $40 area. A real sloppy chart. Massive push downwards, tries to start a new uptrend, and then the 200 says back on down again. So Christopher, again, with everything I said, the wild gyrations, the potential lack of liquidity, all those cautions, maybe if you really feel the $40 range has been long-term historical support, maybe accumulate in the 40s. But if it breaks this all-time low of 30, I'd watch out. I'd watch out on this one. You know, it might seem inconceivable, but if this 30 to 40 range doesn't hold, this could be a stock in the $10 to $20 range in a heartbeat. So once again, this is not really going on an IFT pattern or an IFT strategy. It's just sort of focused on these wild gyrations and these wild moves, and the fact that even with the wild moves, it seems to hold that $30 to $40 area repetitively. So I hope that helped a little bit, Christopher. Let me go to Airbnb. Let's see. Oh, I'm sorry. I'm going to go back to the Sage one. I wanted to at least go down to the daily chart. I only went to the weekly. I have a feeling the daily might be in a downtrend. And that's what I wanted to point to also, right? After breaking the 200 on the daily, it definitely was in a downtrend. let's go through the phases of market law 4. Let's go through the phases of market law 4 very quickly. Number 1, 3 to 5 to 8 moves. Definitely has done that as far as an average trend. Then let me ask the question, has the downtrend been broken, yes or no? This is on the daily now. Has the downtrend been broken on the daily chart, yes or no? The answer is yes, right? Remember how you have a market law 2 break of a trend. Remember how you have a market law 2 break of a trend. Here's a downtrend. Then you have your pullback. Okay, is that a break of the downtrend? No, you're just pulling back. Now you're touching the downward 20. Is that a break of the trend? No, you're just touching it. Now you're piercing the 20. Is that a break of the downtrend? No. Now your next bar goes higher. That's a break. One bar closes above the downtrend, another bar goes further. We'll take a look at this. One bar closed above, and another bar went further. The downtrend is broken. Does that mean you automatically flip to the upside? No. It just means the downtrend is no longer reliable. It's been broken. So it's right in the middle of forming its first higher high and higher low. So there is no confirmation of an uptrend yet, but the downtrend has been broken. So that's probably the best I can do for you on this one, Christopher. It just seems like historically, when you go out to that monthly and weekly chart, that this $30 to $40 area holds, and your daily was on a downtrend, and the downtrend has been broken. No confirmation of a switch to an uptrend yet, though, based on market law 4. All right, let's get to Airbnb. Let's see, who was Airbnb? There's a lot of resistance there where the downtrend is broken. I don't know where you see the resistance, right? I see support, Perry. I see the support, repetitive support of this $30, this 30 to 40, well, this, to be quite focused, this $38 area. The next resistance I see, Perry, is here in the $50 range, right? All this consolidation. Otherwise, you make a new lower low, a new lower high, and then you take that out. This could have a run from the 40s to the 50s pretty quickly. It could also come down and break the 30s and become a $20 stock in a heartbeat. So, just, always be on top of your game. Always use that risk unit. All right, Airbnb. Perry, right. You're looking for support areas to hold you up in an uptrend, and you're looking for resistance areas to keep you pushed downwards in a downtrend. And Perry, I am with you. I was always reversing those. I suffer from a slight bit of dyslexia, so things like support and resistance and the left and the right and all that took a little bit of extra work for me to get through. But I'm not saying you're dyslexic. I'm just saying I understand when your mind flips that a little bit. All right, Airbnb. Go up to the monthly chart just for the fun of it. Not much on the monthly chart because it was an IPO in 2020, so I'm really not even going to peek at the monthly chart. Let's see if I even have enough data for a weekly chart. If you think about it, since the IPO, it really hasn't done much. Now, you may say, well, it hit 220 and then went down to 125. Yeah, it was as high as a $200 stock and as low as a $100 stock, and that's 100 points in between. But chart-wise, it really has done nothing. It's kind of sideways. Let's go down to the daily. Daily chart. All right. On this one, it looks like that $125 area is some significant support. Had a sloppy downtrend, then went sideways, and now has taken out the equal highs. Could we be in the beginning of a new uptrend? Here is your first pivot, your first higher high and higher low, right? New higher high, your higher low is formed. What was once resistance, the equal highs become support. This is the birth of a new uptrend, James. Will it endure? I have no idea, but this is the birth of a new uptrend. Does it have some work to do? Sure. Once you start getting in that 170 range, look at the former consolidation back here. But I would say this was a very worthwhile, here, let me get rid of some of this. I think this was a very worthwhile VBS or gift play back there. Right now, is it triggering right now? No. The last trigger was back here. I don't care if you call it a gift play based on this elephant move. I don't care if you call it a VBS off of the newly rising 20. You had one new higher high, one new higher low, and then it took off. Boom. You're beginning a new uptrend. So that's Airbnb. Let's go down to the 15-minute on this one, too. I'm just curious. Can you swing trade the 15-minute? Sure you can. You could take trades on the 15-minute that last a day or two. Yeah, see, I was hoping to see a 20 that held up, but no. We had this beautiful burst of momentum. We had, gift plays and VBSs, but now we're back below the 20, and the 20 has flattened out. I was hoping there'd be a little bit more follow-through momentum on the 15. Absolutely, you can swing trade the 60-minute. Now the 60-minute, we're having a little bit of difficulty because the 200 does not show up. Let's see. Let's take a look at the 60-minute. So my 60-minute, I know Dan is working with a way of tricking and fooling the 60 minutes so we could get a 200 on here, but my 60-minute does not have a 200. And you know what? I like the VBS, James. I like the VBS. In this case, a VBS, well, again, this is where subjectivity comes in place. Is this gift formation here in this RBI your first new higher high and higher low? So this is really a second move, and now you have an uptrend started? Sure. I like this VBS here. Enter here, stop under the low, and you really haven't gone much further since then. I like this RBI back here. If you fill in the bullishness from an IFT perspective, you definitely have some elephant ignition here. Then you have an RBI, enter there, stop under the low. Once up 1 hour, don't lose money. Once up 2 hours, go home with money. A decent looking 60-minute chart from a bullish perspective, James. All right, the next one is a Forex pair. I'm excited. We rarely get questions about Forex here. You're welcome, James. So let me bring up my Forex charts. At IFT, we use Sterling Pro for live traders. Whoops. I grabbed the wrong set of charts. I hope I don't have to reboot. Let me close my equity charts. Yeah, I have to refresh one moment. What I did just froze things up. Give me one moment. Okay, let's get to the Great British Pound versus the US dollar. And was that for Sunny? Yes, for Sunny. And I'll start up on the monthly time frame. This is the euro versus US dollar. Let me get the Great British Pound versus US dollar. Okay, starting with the monthly, just dead sideways, going nowhere. Equal highs, equal lows. Um, it battled the 200 back in 2013, but now, had to move down and now is consolidating sideways again. So monthly, nothing of interest from an IFT perspective. The weekly, had some very interesting bullish momentum for a while, right? We were sideways, then broke above the 200 and finally had follow through, taking out the equal highs. But it was short-lived, and the 20 was broken, and we're sideways again. So nothing of interest from the weekly. Now, as far as Forex is concerned, you can definitely swing trade the weekly chart. We actually have a long-term member of the Forex program that trades his own money, and that's the only thing he does is trade weekly charts. He's a swing trader who trades weekly charts in Forex. Let's get down to the daily. Now, here's where you can start testing your perspective on the charts. I don't want you to think you could become clairvoyant. You're not trying to get ahead of things and think you know the future. But once you know your charts, you can start seeing things, and I wouldn't be surprised if the daily looks predominantly sideways. Why? Because look at these last 20 bars weekly, just flat and going sideways. So let's take a look at the daily and see where we're at. The daily chart, really just sideways, right? Try to make that move upwards, but just sideways and sloppy. And the 200 really isn't holding us either. We're a little bit above it, a little bit below it, a little bit above it, a little bit below it. Here's what I would like to see on this daily, Sonny, before I took any action. I would want to at least get back in this open bullish area up here, or preferably even take out these former lows and really see a downtrend start. But right now, nothing much on this daily for me. 15-minute, have a feeling we're going to see a lot of sideways sloppiness also. I'm sorry, what am I saying 15-minute? 4 hours next. 4 hour, really gave a try at an uptrend, but the 200 has stopped it. Kind of no man's land again. The last real good trade on this 4 hour from an IFT perspective was the VSS right here. Not just the fact that it ran really well, which is beautiful, right? If you entered there and put the stop over the setup, that would have been like a 3, maybe a 4-hour trade. But I'm talking about even the ignition, right? Came into the 200 held. Then it ignited bearishly, pulled back a little bit, and then had its follow through. That's beautiful. Since then, it's been kind of sloppy. Excellent, Sonny. I'm glad this is helpful to you. I'm glad at some degree we're on the same wavelength. Then the 1 hour. The 1 hour, we have a downward 20, and price action now is under the 200 also. I just wish the 20 moving average held, right? We have a market law 2 break of the 20. Maybe playing a resistance bounce off of the 200, but I'm not crazy about it because it broke the 20. I really wish this 20 held. I would have been all for giving the VSS a try if the 20 held. So I'm really not seeing anything overly exciting from an IFT perspective for swing trades on the Great British Pound versus the US dollar, going all the way from the monthly down to the hourly side. So on that note, everybody, boy, what a full session, right? Talked a lot about really general perspectives of the equity market. Took a look at the equity market from the overall market via the SPYs, and then the technology driving sector via the Qs, and the financial sector. We got into some reviews of things like VBSs and VSSs, and we definitely touched upon a few stocks and one currency pair, and also threw out a few trade ideas, most of them coming from the general market. So, Walter, Ty, Tal, Sonny, Perry, Matt, James, Christopher, Brian, Betty, and Audrey, thanks for being here today. We really have a really nice, tight-knit Wednesday community gathering here these days. I really enjoy it. I'll see you back here 1 p.m. Eastern next Wednesday. And if you need them, stick around. In about 3 to 5 minutes. In about 2 minutes, I'll put up the last 2 recordings, including today, and I'll leave the room open for about 2 or 3 minutes if you need to grab them. Other than that, I'll see you in the other programs. Forex traders, I'll see you in the Forex program tomorrow morning in the 8 o'clock hour. Equity traders, I'll see you after Dan finishes in the equities room tomorrow. We have a continuation of a couple of lessons there. And everybody else, I'll see you back here 1 p.m. Eastern, approximately 1 p.m. Eastern next Wednesday. Thanks, everybody.